Well, hello everyone and welcome to today's webinar here at TradeStation. My name is Dr. Don Prattle. I am the Director of Trader Development and Education here at TradeStation, and I want to welcome you to a wonderful presentation. I know it's going to be a wonderful presentation. We have enlisted for you two very gifted presenters from EZ Breakouts, Mr. Russ Hazelcorn and Mr. Matthew Inouye. EZ Breakouts, as they will describe it for you, will provide us today with a clear, simple, step-by-step blueprint for day and swing trades. Whether the market is moving up or down, we hope that they'll be able to teach us precise strategies for market direction. And their presentation today, the 4 key chart patterns traders need to know, will help us get there. Thanks to everyone who answered my question in that chat box about attending for the first time. It's good to know exactly who we are servicing here in our presentations, so I want to thank you for participating in my short informal survey. Before we turn things over to the folks from EZ Breakouts, I need to talk about some of the disclaimers. Our presentation is for educational purposes only, and all the symbols and trading ideas that we discuss here are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business. Active trading is not suitable for everyone. Options trading also carries a high degree of risk and may not be suitable for all traders. I have pasted into the chat panel 2 different disclosure documents regarding risk assessments and the characteristics and risks of standardized options. Also in the chat panel is the upcoming forecast or preview of our TradeStation webinar series. Today's webinar series presentation, as I mentioned, is going to be provided by EZ Breakouts. Be in the right stocks at the right time. And they're going to discuss with us EZ Breakouts chart patterns. So Russ and Matt, take things over.
Definitely will. Thank you so much, Don. You can hear me loud and clear? I'm assuming everybody can hear me. Hi, everybody. My name is Eddie Z. My real name is Russ Hazelcorn, and we're going to present to you today our EZ Breakouts chart patterns. And the cool thing about our chart patterns is there are only 4 that you really need to know to be successful in the stock market. And we're going to talk about those today. In fact, here is what we're going to talk about. We're going to talk about what are our favorite chart patterns, those 4 patterns. We're going to talk about really deeply which pattern is our favorite pattern, and we're going to explore it in depth. We're going to talk about what is this favorite of ours, what's its exact shape and specifications. We're going to talk about what exactly is this thing we call a breakout. We're going to look at quite a few examples of this chart pattern, and we're going to talk about a strategy to help you find and trade this pattern easily. So, my name is Eddie Z. As I said before, I am the creator of EZ Breakouts, and just a little about me. I have 30 years of Wall Street experience. I started back in 1987, day after I graduated high school, on the floor of the NYMEX. Very fortunate to have that opportunity as such a young man. 17 years as a stockbroker at New York Stock Exchange member firms, and 19 years, which is now 20 years, of electronic day and swing trading experience. I have an MBA from Lehigh University and a degree in accounting from Penn State. What I'm really excited about is introducing my co-presenter today, Mr. Matthew Inouye, who is our Vice President of Education at EZ Breakouts. And I feel very lucky to have him as an instructor, our main instructor for our courses. Matt has 9 years experience with William O'Neill and Company's Investor Business Daily and with MarketSmith. He worked there directly with a gentleman by the name of William O'Neill, who is the founder, wrote a book called How to Make Money in Stocks, literally created the Investor Business Daily and some institutional products. He was an equity analyst, a trading coach, and a public speaker there. He's also done portfolio analysis for high net worth individuals and has also done missile guidance and telemetry for the U.S. Navy. So I'm super thrilled to have him as really not only my co-presenter, but working together in helping educate traders. So with that, I'm going to pass it right over to Matt for the first part of this presentation. Matt, are you out there, buddy?
I am. Can everyone hear me? Can you type a Y or a yes into that question panel down below?
I hear you just
great.
fine.
Everyone. Awesome. Well, Eddie, thanks for that introduction there, and to Don and the TradeStation team, thank you for having us. Very, very good to be here. So like Eddie was saying, I have a few years of trading experience, but most of my time here in trading has been centered around reading charts, interpreting price and volume action, and so we thought it was appropriate to share that in our presentation today. So let me go ahead and take controls of the slideshow here. And so again, today's presentation is all about the breakouts or the chart patterns that we look at in easy breakouts. We're going to focus on 4 main ones, and then most specifically, there's going to be one chart pattern that we really want to dive deep on it and show you guys the intricacies and the nuances of what we want to look for in these chart patterns. So that being said, the first one, and you may have heard about this chart pattern before, it's no secret, especially if you've ever read that book, How to Make Money in Stocks. This is a chart pattern that's referred to quite often. It's called the cup with handle, and it's named so because it kind of represents sort of like a teacup, like a saucer, with a bit of a handle on the end of it. The way that we normally like to buy these cup with handles is as it breaks out through this sort of secondary pullback. You can see I've got a green dotted line above there, so that would represent the buy point of a cup and handle. The next chart pattern that we tend to find when we're looking at big explosive stocks is something called a flat base. Now you have to understand that all of these chart patterns, they're continuation patterns from strength. So what you typically find is that a stock will run up 20, 30, 40%, and then it's got to have a little bit of a breather. There's some profit taking it coming in. Maybe it has to let some of the earnings reports catch up with it. But that's what these chart patterns really involve. And like this flat base, some of you might hear it referred to sometimes as like a range, or sometimes they're called like a pennant or bull flag or something like that. It's just this period where the stock goes sideways, and as you start to emerge from the highs, that's the breakout we'd be looking for on a flat base. Another one is called a double bottom. It somewhat looks like and resembles an asymmetrical W. Normally, I like to see a little teensy bit of an undercut on that second low. What you're really doing is you're serving to shake out anybody who's been in the stock prior to that and has somehow managed to survive the first pullback in the stock. So that second pullback usually gets them, stops them out, and that sets the stage for a powerful breakout to the upside. Typically, you want to try and buy these patterns as they're emerging from any sort of prior resistance level. When you look at this double bottom, typically that's the midpoint of this W. Sometimes you get a little bit lucky and there's another resistance point that you might be able to pick off. But this is sort of the typical scenario of a double bottom. And then finally here we've got the high handle. High handle, you might have been, you might have heard it been referred to as like a bull flag. That's sometimes referred, or high tight flag. But that's basically, the same thing. It's a high handle. It has a really nice run up, maybe 10, 15% run up, and then it consolidates sideways in a very narrow and a tight range, anywhere from 4 days to sometimes 3 or 4 weeks. And then as it starts to break out from some of those prior highs, that's where we'll start to take a look at those. All right. So that being said, here, folks, the chart pattern that we tend to find the most often, and that does tend to provide some very powerful breakouts, is the cup and handle. One thing I'll just share a story with everyone who's in attendance here today. So I've been working in the business for quite some time. In fact, this was one of my first jobs. I got a job. I'm an engineer. I got a job as an engineer coming right out of school, and I quickly figured out it wasn't the space for me. And so I quickly found that I really loved trading. I tried to find out any firm or company that would hire a kid right out of school. And one of the things that I ended up doing is I ended up working with a company called William O'Neill and Company. Some people might know it as like the parent company of IBD, Investors Business Daily. But when I got hired onto the firm, one of the things that I found is that I was assigned a lot of grunt work. And this grunt work was actually taking these old copies of Wall Street journals back from like the early 1900s. They scanned these old archived versions in, and we would take these PDFs and we would go through all of these companies that really a lot of them don't exist anymore, like Tennessee Coal and Iron, a bunch of these rail companies. I saw United States Steel on there, so that's actually still around in some form. But when you look at all of these old companies, we would input the high, the low, the close, the volume, as the Wall Street Journal had printed it back, over 100 years ago. And what we did is we actually created from scratch a database of charts back in the 1800s and the early 1900s. And one of the things that we found is that when we see cup and handles in like, the big run up before the late 90s, or even like the cup and handles in Apple in 2004, these cup and handles look very, very similar to the runs that some of these rail companies had back in the late 1800s, the early 1900s, the 1920s leading up to the 29 crash. There are cup and handles galore, and they look very, very similar in structure to how a lot of the chart patterns form up even, 80, 90 years later. So, folks, that's why we wanted to dive deep on this cup and handle. Not only do we see it in today's charts, but we saw it, many, many years ago. And quite frankly, I would expect if you were studying the markets, 50, 60 years from now, you would still see a lot of these price formations show up. And we'll talk about why this happens, why we see chart patterns showing up over and over again as we get a little bit further into this the discussion. But that being said, let's talk a little bit about cup and handle. So like I was mentioning, it's got its name here because it kind of looks like the silhouette of a cup, like a mug with a handle, right? That's what it looks like. So if you take away that background graphic, let's just kind of focus in on some of the characteristics that we would normally like to see in a chart pattern of this type. So the first one would be we need to have it be a prior uptrend. Typically, we like to see chart patterns forming near highs, at least 52-week highs, if not even better, like 5-year highs or all-time highs. If you're seeing a chart pattern form and it's off of like a 30 or 40% correction, and then you see a cup and handle form, that's not quite the same feel that we're looking for. So we need to have some kind of a prior uptrend. And then in that first pullback, we typically like to see the pullback be right around 25, 35% deep. Now, if you see a big correction that's like 45 or 50% deep, usually that's not what we would consider a cup and handle. And the reason being is that it takes a lot of buying power to come all the way back up close to those prior highs. So let's say you were at 100 and you corrected down to 50, you had a 50% pullback. That actually means you have to go up 100% just to get back up to even, right? 50 going up to 100. That's a 50-point move. That's a 100% move. So when we look at the percentages here, we actually like this to be a little bit more well-contained, like 25, 35%. That way it doesn't take a lot of buying power to get it back up to the original spot. You won't have people that'll be like, hey, I just made 100% in 5 weeks or 6 weeks. I'm going to sell that and lock it in, which would cause supply to come in on your stock. And that's something we actually don't want to have happen. So 25, 35% deep. Normally, we'd like to see them form at least 7 weeks. So this is a very important distinction, which is where some people might say, hey, I see a cup and handle. And they're looking at a 5-minute chart. And it's like, okay, yes, it's a cup and handle. It's got the shape. But really, what we're looking for in the chart pattern is a series of price events that would actually cause a lot of weak holders to be shaken out or shooken out of the stock and their position. So if you're looking at it on like a 5-minute chart and you have like a 30-minute time span, that's really not enough. That's not what we're looking for. We're looking for something where an active trader might be tired of the stock, just tired of hanging on to it, 7 weeks, 8 weeks. They're like, this is dead money. I'm selling this thing. I'm out of here. And so that's why we have to have the duration aspect of it as well. So at least 7 weeks, and that includes the handle. When we look at the right side of the cup as it's coming back around, coming back up to the prior highs, what we'd like to see is that it recovers the majority of the highs. It doesn't have to recover all of it. So let's say, again, as an example, you had a stock that ran from, $20 up to 100 and then started to pull back down to like 80 or so. It starts to round out. It doesn't have to come all the way back up to $100. Maybe it comes back up to like 90 or 95. And then it starts to form a handle. Now, what the handle does for us is it gives us one final shakeout. So if you kind of think about this from a psychological standpoint, if you had a stock that ran up from, say, like $30 or $40, and it ran up to $100, and then it started to pull down to 80 to 75, you're probably sweating that just a little bit, right? You're like, man, this stock was at $100 just, like 4 weeks ago. Then all of a sudden it starts to recover and you start to breathe a little bit more easily, right? I mean, you guys know that feeling. Most of you have been trading some time. You know that feeling of when a stock goes against you and then finally comes back. There's this sort of this weight that's lifted off of you. You can breathe a little bit more easily. Now, what the handle does is it starts to go back down. And so what a lot of traders will immediately kind of snap to is like, uh-oh, I don't want to go back down to $70 or $75 again. I better sell this up here at $90. It was at 100, but I'll take 90. I better just sell this now because I don't want this to go back to 70 or 75. And so that handle serves to shake out the last weak holders from the position. It shakes out that supply. And basically, if the handle can then still break out from this point, you've got a lot of demand. You've shaken out a lot of the weak holders. And really, the only way you're going to unlock further supply for the price is for the price to go higher. So this is why we start looking for these chart patterns. It really is a representation of human emotion on parade. This is everybody's hopes, fear, their greed. It kind of manifests itself in these chart patterns. So let's take a look at some of the things to watch out for. A wedging handle. So wedging handle means that instead of coming down 10 or 15%, the handle kind of slowly creeps higher. So if we think about the handle needing to shake people out, if you're actually grinding higher, everybody's still making money. You're not scaring anybody. So this could mean that when you try to attempt a breakout, you still have some people who might come in as weak sellers and they'll cause supply to come out on the market. That's just something we don't want to have happen. Also, a low handle. So a low handle, we have to be careful of this because we don't want to try and buy something when there's a lot of something what we call overhead resistance. So anybody, let me see if I can get this line pen to come up here. Let's see, anybody who kind of owns this stock in this period here, okay? If the stock starts to round the corner and come back up, a lot of these people who have been looking at losses on this whole way down are now going to start saying, oh man, my investment has come back to break even. Whew, I can finally sell it, right? You ever heard that saying, I can't sell it now, I'll sell it at a loss, right? Kind of silly, but even if you're looking at a loss, whether you sell it now or you hold on to it, it's still a loss. But somehow people tend to kind of internalize that the stock really isn't a loss until you sell it. So if it comes back up to where they originally bought it and then they sell it, then they can get out of the stock without taking any damage. And so anybody who's bought it at a higher price, that's what we call overhead resistance. So when you have a very low handle here and maybe you try and stage a breakout right above this level, okay, something like this, all of a sudden these folks who are in at these upper levels might start to say, hey, you know what, I sat through a pretty big drawdown. I just want to get out of this stock. There's this other stock I'm watching that's running. I'm going to jump on that one. And so they'll become sellers. So this is why you have to watch out for low handles. We typically want the handles to form, again, closer to the prior highs such that there's nobody left to sell the stock. Okay, let me see if I can delete some of these. All right, there we go. One other thing is when we talk about low handles, we can quantify what we feel is a low handle, typically if it forms up below the midpoint of the base. So if a stock went from, say, $100 down to 80, there's a 20-point spread on that. Typically, you'd want the handle to form above the $90 level, right? $90 would be the midpoint from a base that went from 100 down to 80. So if you have the handle forming up at like 85, that's below the midpoint of the base, and that would be considered a little bit low for a traditional or a proper buy point. Okay, any questions on that before I start moving into some of the examples that we have lined up for today? Any questions on that? I've got Bill here asking a question. Do you also use this formation in an inverted fashion? For example, like upside down cup and handles, or up like a flat base that's breaking down. Bill, you know, I actually don't do much shorting. I'm more predominantly long-sided trading, but the thought process behind it would be absolutely the same. If you have a stock that's coming off, and then has a significant bounce, let's see if I can draw it. So, you know, in your case here, Bill, the stock comes down, has a bounce up, and then kind of forms like this, kind of rallies back just a little bit. That's kind of a cup and handle in reverse. And if you start to break down from that, that just indicates to me a lack of demand, right? Just like if we were to see the exact opposite happen, so here's the cup with handle, and you start to break up, to me, that's a lack of supply, right? And a lack of supply means higher prices to me. A lack of demand means lower prices to me. So, Bill, I would say in my eyes, I mean, you know, Eddie might have an answer on this later on in the presentation, but at least in my eyes, this to me, they're analogous. They're just 180 degrees opposite, okay? But thanks for asking that, Bill. That's a great question. Let me go ahead and delete that. All right, so let's take a look at some of these examples and how they play out in the real world. So one of these examples is TIE, is the ticker, Titanium Metals. This is a stock that started to form up here. Looks like the scaling got a little bit skewed on this one, but this is actually from January of 2005. And you can see here that it's a $3 stock. Now, we don't typically trade $3 stocks. So what I was going to explain on this slide is that this actually went for two 2-for-1 splits and an additional 3-for-1 split after it broke out. So all of those splits actually had the net effect of pushing the initial breakout price down. But this was actually about a $20, $30 stock before it actually broke out. And what you'll see on this chart here, let me see if I can advance the slide, is that there's a little bit of a cup with a handle. Okay, you can see that silhouette here that's forming. Now, some of the things that we're going to look for are the characteristics that we just went through in the prior examples, which is a prior uptrend, right? This thing goes up 85%. We only needed like 20 or 30, so we got a good check mark there. The depth of the base from the highs to the low of the base, 30%. That's within the range of about a 25, 35% pullback, correct? The length of the base, let's check this out. This is a daily chart, so each one of these ticks is a day that goes by. It's a 16-week time frame, so that's actually fairly good. And then finally here, when you look at the high and the low of the base, and you just draw a midpoint across the high and the low, you can see that our handle is forming way above, almost at the original highs. So in this case, we have a check mark on that end as well. So this, on the grand scheme of things, meets a lot of the characteristics and the criteria we would be looking for in a cup and a handle. Okay, now the way we buy this is right through the prior highs, and boom, the stock breaks out. So you can see here it breaks out, and there's huge volume that comes into this thing. Folks, this is to me what breakout should look like. You know, a lot of times you might see a stock that meanders a little bit past the prior high. The volume doesn't really come in. that to me doesn't strike me as a breakout where everybody is just scrambling to buy shares because they see so much value in this company or in this stock. So to me, a breakout, you got to have that volume. That really helps to give it a little extra conviction that there is just a ton of demand and very little supply. And so the only way that people that want the stock can get the stock is they've got to outbid everybody else. And that is how the prices will move higher. You've got to outbid your competition, and that keeps pushing the prices higher. Okay. All right, let's look at the move that this ensues on. Seems like the scaling got a little off, but it actually goes up about 1,300% in a little over a year. So 1,300% from the initial cup and handle to where the peak of the stock actually occurs is about 1,350% in just a little over a year's time. It's a huge move. Now, here's the thing to recognize about what these chart patterns represent to us is that these represent institutional accumulation of a stock. When we see like a flat base or a double bottom or a cup and handle or high handle or anything like that, what it represents to us is that there are large investors that are starting to slowly accumulate shares, and their buying or selling action is being represented by these chart patterns. Okay. Now, when you think about say like a Fidelity Contra Fund, right? Over $100 billion in assets under management. If they even wanted to take a 1% position, so 1% of their fund into like a stock, I don't know, like say an Apple or Facebook, they have to do buying for many, many weeks to be able to buy 1% of $100 billion, right? That's a lot of buying power that has to go into these stocks. So what we tend to find is that when we see these cup and handles, they'll form over many, many weeks and months. And even though it breaks out, the move may not be done because these funds will take a long time to continue purchasing a stock. And if the fundamentals keep improving on the stock, chances are the funds are going to increase their stake in the stock, and it's going to attract additional fund managers. So that's why when we look at these chart patterns, we're trying to play for these bigger moves as potentially the funds take positions over many weeks and many months to try and recognize a potential value in that stock going forward. Let's go on to the next stock, CME Group, okay, the Chicago Merc. So CME broke out in January of 2004, and you can see here big cup and handle, right? Let's check out the stats on this. Do we have a prior uptrend? Yes. What's the depth of the base? It's 23%. Perfect. Length of the base? 25 weeks. It's almost like a half year long, right? 6 months long. And then does the handle form up above the midpoint of the base? Yes, it does. So all of these things are our check marks. They're meeting our criteria. And our buy point is right through the high of the handle. And it also actually kind of coincides with the high of the base altogether, the left side high. And here it is, breaks out, big volume, boom. This is a breakout. And CME goes on to run 650% over the next approximately about 158 weeks. Okay, so about 3 years, it runs up about 650%. Nice move. And we all found it starting off with the cup and handle. Let's take a look at another one, Mosaic. How many of you in the room remember trading the fertilizers in 07 and 08? How many of you guys and gals out there were trading the fertilizers? Potash, Mosaic, CF Industries. You guys remember those folks? They were the hot stocks in 05, 06, 07, leading up into that. So Mosaic here forms up a nice cup and handle right in 2006. Okay, you see this cup and handle we've traced out. And in fact, you can even make the argument here that it was trying to form a bit of a cup right in here, okay? And as it formed the handle, it just never broke out. So now you just start looking for a new potential entry point, and this stock actually forms another cup and handle, you know, right at this level. So that's an interesting thing to watch out for, is when you see stocks that are like keep forming you know, cups and they never really can break out. When you see these cups kind of stack up to each other and all the buy points are kind of right at the same level, to me that indicates there's a lot of supply above. And if you can break out, that indicates that whoever was selling at those upper levels is gone. And now potentially there could be very little supply because the big seller is now gone. They've sold everything they wanted to sell. And if any teensy bits of buying or demand comes in, it's going to break this out higher. So this is Mosaic back in 2006. 30% uptrend, check. Depth of the base, 24%. That looks good, acceptable. 22 weeks long, perfect. Way in excess of the 7 weeks we would normally need. And does the handle form in the upper half of the base? Yes, it does. Okay, our buy point is right above the high of the handle, which is also actually above the high from these last two pullbacks up here, right in this area, right in here, coincides with the buy point of this cup and handle right there. And then we get the breakout, and we've got the big volume coming in too. Again, just overwhelming demand. So the path of least resistance at this point is actually higher, and that's what we want to look for in these breakouts. Mosaic goes on an almost 850% run in about 90 weeks. Just monster move, and all of them are running. Potash, CF Industries, IPI was another one. So all of these stock tickers were running at the same time, and it all started. We were able to recognize that the shares were under accumulation via the cup and handle that started to form. Okay, let's talk about a cult favorite here. So a cult favorite, you know, these are just those stocks. It's kind of like, you know, like a Netflix or an Apple. Everybody talks about this. Tesla. Now Tesla, yes, everybody's been talking about it, but that hasn't always been the case. And in fact, if you were trading just 3 or 4 years ago, nobody would have even given Tesla a second thought. It's this kind of quirky electric car company. They use the Lotus Esprit model, and they kind of put in their own electric motor in there. It really wasn't setting off a lot of radars for investors, or alarms, I should say, for investors. But if you focused in just on the charts gave you a heads up that there were institutions that were starting to take a position in this stock before it became this hot stock that everybody was talking about. So if you look back at a chart in Tesla, this is back in April of 2013, what you see here is a big cup with handle that's starting to form up. So let's go through our checklist. Prior uptrend, absolutely. The base, 36%, a little bit beyond what we normally like, but it's okay. You know, 25, 35 is what we're looking for. This is 36. That's completely fine. We just don't want to make sure, or we want to make sure we don't have like a base that's a 50% correction, okay? 52 weeks. So this thing is basically marking time for a whole year, okay? And then the handle forms in the upper half of the base. Can you imagine Tesla at one point was $37? Oh my gosh. Seems like a bargain. And here's the buy point right above the 40 evens. So taking a look at that, you know, this stock breaks and gaps up powerfully, a huge volume. Folks, this is how you know that the institutions during this whole process here, institutions are just soaking up all the shares that are available to sell, okay? Anybody who wants to sell it, these big institutions are just soaking it up, and it gets to a point where when the supply starts to dry up, then the institutions have to start paying up for the stock, and that's driving the price higher. You have this one final shakeout in here, and then once the earnings get released, boom, there's just no shares available to purchase because the institutions have soaked all of it up. So the only way that somebody can purchase shares is they got to really pay up for the shares, and that's what causes these breakouts or even gap ups, especially on earnings. So this goes on a monster run we're all familiar with, obviously, if you've been trading for any length of time. The Tesla here goes on a 630% run in just 75 weeks, year and a half. Pretty crazy stuff, right? One final example, but I wanted to make this point about the Tesla. So we see these cup and handles forming, and someone was asking the question earlier, do these tend to work with other things like commodities or anything else? And I would say my tentative answer would be yes. I think Eddie would probably concur with this as well, but my answer is yes. And the reason why I say yes. Oh,
I do
Eddie?
concur, Matt.
Yeah, I was just going to say, sounded like you hopped on the line there.
Yes, I do concur.
Yeah. Any thoughts
so
before I continue? Or
I would just say that they do occur in every market. In stocks, they have, in my opinion, they have a much more important meaning, because when it comes to stocks, I don't want to go into a deep explanation of this now, but I would just say when it comes to stocks, the number of shares in any given stock is fixed. When you trade commodities or you trade Forex, the number of available contracts is not fixed. It can literally be almost infinite. Well, in futures, it potentially can be infinite. So stocks, when you have a limited supply and institutional accumulation, where institutions are actually grabbing the shares, putting them away, a company goes public, they issue X number of shares, and that's the only available shares available to the public. It's called the float. When those shares are gobbled up by institutions, these chart patterns can lead to enormous moves very, very quickly. So for that reason, we focus on stocks. And in my opinion, trading stocks is easier than trading all the other markets. Take it away from there, Matt.
all right, thanks for that, Eddie. Yep. So I agree. Everything with what Eddie just said there, and so answer is yes. And I would even say for some of you, this might hit a little bit closer to home. You might understand this because I'm actually pretty familiar with the real estate market. Okay, and think of it this way, right? There's only X amount of homes that are for sale at any given time, right? It's not like you can just pop up new homes within a couple of weeks. It takes many years to bring new homes online. So with a fixed supply, okay, how many of you have been watching the real estate prices in your area skyrocket? Like I've seen some people here, they said they were from San Francisco. I mean, it's just the prices are crazy, and it's because people want a place to live near their work in San Francisco, a lot of these tech jobs. And you know what? If they've got to pay up for it and they got to pay $1 million for a little, one-bedroom flat, they're going to do it. They're going to pay for it, and that's going to skyrocket the prices higher. Same thing happens whether it's in stocks or oil or gold. Anytime you have some sort of a supply and demand imbalance, it's going to spike your prices, okay? Here's a great question that's coming through. John was asking a question. How many weeks does it take a handle to form? And so, John, to answer your questions, in the most simplest form, if you're looking at a base that's about 7 weeks, you only need 1 week in the handle, okay? Now, let's take that and compare that to Tesla, which is 52 weeks in length. I make the sort of the call or the judgment here that if you've gone 52 weeks sideways, a 1 week handle or a little bit of a last pullback for me doesn't cut it. If something has gone sideways for 6 months, 10 months, 12 months, I'm looking for a handle that's probably going to be in the range of at least 5 weeks long, 6 weeks long. There's kind of like a proportionality of how long the base is to how long the handle is. Does that make sense, John? But that's a great question. Thank you for asking that. A couple of people just mentioning they remember trading the fertilizers back in the day. One final question, then I'll move on to the remainder of the slides here. Joe is asking, how do you measure to get the 36% drop in a stock? Like, how do you measure the depth of the stock? The easiest answer for this one, Joe, is let's say your stock was at $100 and it drops down to 80. The difference there is 20 points, right? It was at 100, now it's at 80. So your difference there is 20 points. That 20 points divided by your original starting point, which was at 100, would yield that that's a 20% drop off the top. Does that make sense, Joe? So Joseph, hopefully that answers your question there. But the way you measure it is the distance from the high to the low. So the difference, right? You subtract the two out, you get that distance, and you divide that distance by your original starting point, and that's the percentage drop from the highs. Great question. Okay, So, wow, I can tell we've got an engaged audience. That's awesome. A lot of questions flowing through. Hopefully, Eddie, you and I will have a chance to maybe clean up some of these as we get towards the back half of the presentation. But keep them coming,
Yes.
folks, because we can read up. Eddie, it sounded like you had hopped on there. Did you have something to add to that?
I was just agreeing with you. I'm with you.
Okay, terrific. So one final example here as we're looking through these chart patterns. We went through Tesla, Jazz Pharmaceuticals. Jazz Pharmaceuticals in May of 2013. You see that Jazz has this bit of a cup and handle. By the way, do you see something similar to what we saw with Tesla? We had Jazz coming up here, tried to break out, couldn't make up those highs. Maybe it did for like one day and then fell back down, okay? Indicating that there's some sellers up there that's pushing the prices back down, and then forms up this tighter, more constructive cup and handle there. Very similar to the Tesla or even the Mosaic, where you have these multiple cups that start to form, and then finally it breaks out in volume. Okay, and we're going to see that in just a second. This is a very powerful thing when you see the stock keep coming up to a level, keep forming these cups, but not able to break out. Then it finally forms this really nice, tight, shallow, constructive base, and it breaks out from that. It's a very good thing to see. All right, so in Jazz Pharmaceutical, we see that it has a 28% run-up, even more if you count from back in the July period. It has a 16% depth, so it actually is a very tight cup and handle compared with the normal 30% corrections that we see. 16% means that the funds just did not let this go down. They snapped up any sort of discount in the price. They snapped it up. Okay, 10 weeks long, so this is a very short period as well. And here's the buy point, right above the 60 evens there, breaks out, big powerful volume, and Jazz Pharmaceutical goes up about 190% in just about a year. Okay, all starts with a cup and handle on the very initial breakout. And folks, this is how we start to recognize stocks that are potentially being accumulated by big funds, and the path of least resistance might exist to the upside. So Eddie, I wanted to pass it over to you, but before I did, I wanted to ask you a question on this one. I've got some
Sure.
real-time examples of stocks, and I didn't know if you wanted to maybe go through it now, or do you think it might make sense to go through it after some of your presentation?
Why don't you go through some for about 5 minutes if that works for you?
Sure. So what I'll do
I
here, gang.
recognize everybody's time is super valuable, and I know we had set aside 60 minutes for this webinar, but we want to make sure we get to all the material. So if you can do it in 5 minutes or less, I think now is the appropriate time.
Okay, terrific. Let's go ahead and share my screen down below. So folks, give it just 1 second. I'm going to go ahead and share my live screen so everyone can see it. And can you guys confirm that you see my charts of the SPYs on my screen? It's a daily time frame of the SPYs. Great. Looks like that works. Okay. So you might be thinking to yourself, okay, well, that's great, Matt. You've cherry picked out 5 examples of a cup and handle that have worked. How realistic is it that I'm going to be able to pick these out in real time? And I would make the assertion that it's actually very realistic. In fact, there's a couple of, I mean, you can even almost see it on the SPYs here. There's kind of a cup with a handle even forming on the SPYs or the S&P, right? This is the proxy for the S&P. Right around the 2400s would represent a breakout point of this little cup and handle that the SPYs have been forming. Let's even kind of zoom into some of the stocks we've been trading. So, Eddie and I, we run a live trading room. So some of the stocks that we've actually traded in our live room, and again, I just got to make this disclaimer, verbal disclaimer. I know that Don had put the written disclaimer out front, but just a verbal disclaimer on this one. This is not a recommendation to buy, sell, or hold any securities or any assets. And financial professionals should always be consulted before transactions placed in your account. But bigger picture here, folks, when you look at this, we were actually taking a look at this Weibo, and this WB here, if you notice ever so slightly, let me see if I can change the colors on this, ever so slightly, you notice something here. This is a daily chart. Do you guys and gals notice that? You see that cup and handle that forms out there? Do you notice how the volume comes in? Oh, you know what? Somehow my my line pen, it's ceasing to work here. Oh, bugger. My line pen doesn't seem to be working here right now. Hold on one second. Let me see if I can get that to show up. Okay. Yeah, I think my line pen here, I've got an outdated version of Windows. I've got 7. So there's a bit of an issue there. But let me see if I can do it on TradeStation instead. Let me see if I can pull this up on TradeStation. Where is my drawing palette here? I think I might have hidden away my drawing palette. But I think you guys can somewhat see it, right? Coming in right here, starting right about this level. You can see that it's coming in here, pulls back from the upper 50s down into the lower 40s here, comes right around and forms this handle right above this, let's see, right above this 57 level. You can see that start to form up right there. And so this here, this is that cup and handle that we're looking for. Big, powerful breakout. If you zoom in on the volume, you can see here down at the bottom, the volume has a big volume pickup. And this just happened 3 days ago, and in fact, you might say, well, okay, that's a great example, but can this be repeated? And I would say, actually, some of the leading stocks out there, if you look at Weibo on a weekly chart, this has had a nice run coming out from like $20 up to 62. A lot of times, these leading stocks, as you saw with like CME, Tesla, Mosaic, titanium metals, a lot of these leading stocks that continue to power higher will show multiple cup and handles and bases along the way with multiple chart patterns. If you focus in on right here, I'm going to take you back to April of 2016. Oops. All the way back here. Do you guys see how there's this really giant cup and handle that forms up right in here? And then a more tighter, more constructive cup and handle right here, right at about the $19 level. It breaks out right above $19, and you see the volume spike that happens right here as the stock is breaking out. And so, folks, the reason why both Eddie and I, we look at these chart patterns is because we see them happening in our current markets. We see them happening, in markets we've traded, 5, 10, 15 years ago, even longer. And what's interesting is based on, my experience of building charts back into the 1800s, they used to happen on stocks, 100 years ago. The volume was less. They only traded like 1,000 shares a day, if that. But, the chart patterns were still the same.